Ladies and gentlemen, good day and welcome to the Computer Age Management Services Limited Q1 FY2024 earnings conference call organized by Orient Capital. We have on the call with us today Mr. Anuj Kumar, Managing Director, Mr. Ramcharan SR, CFO, Mr. Anis Savlani, Head Investor Relations. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nachiket Kale from Orient Capital. Thank you, and over to you, sir.
Hi, good morning, everyone. Welcome to the Q1 FY24 earnings conference call for CAMS. As mentioned, today from the management, we have with us Mr. Anuj Kumar, Managing Director, Mr. Ramcharan SR, CFO, and Mr. Anis Savlani, Head of Investor Relations. Before we proceed to start the call, I'd like to give a small disclaimer that this conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date. These statements are not guarantees of future performance and involve risks and uncertainties which are difficult to predict. A detailed disclaimer has also been published in the investor presentation which was released to the stock exchanges. I hope everybody had a chance to go through the presentation. I will now hand over the call to Mr. Anuj Kumar, Managing Director. Thanks everyone, and over to you, sir.
Hey, thanks Nachiket for making the introductions. Good morning, everyone. I appreciate all of you joining this earnings call for the first quarter of the current financial year. We also expect that you have the opportunity to download the presentation either from the website or from other available places, and that you have a copy readily available that you'll be able to reference. I will certainly call out the charts that I'm intending to cover while we go through this presentation. I will start by talking of the overall macro picture in terms of what happened in 1Q. I am on chart number 6 of the presentation. You may have noticed that CAMS has won RTA mandates, 2 RTA mandates in the first quarter, one from Angel One, the other from Taurus Oro. Both of them are new to the industry entrants. Both have applied for a license, are in different stages of obtaining that license. This then takes us to a position where CAMS has won 4 of the last 6, like you may have noticed, of RTA mandates coming from new mutual funds who applied for a license. It's a great vindication of the belief the market has in our capabilities. It solidifies our position, and obviously it's a key highlight for the quarter. Another noticeable thing apart from these wins that happened was, again you may have noticed because these are public figures, that our AUM share of the market crept up from 68.3 to 68.7, largely riding on net sales in the quarter, and I'll cover this in a bit of detail as we skip to the main section after I'm done with the highlights. On alternatives, overall we had a solid 19% year-on-year revenue growth, and coming on the back of 2 previous successful years, I think this quarterly growth is again just sound testament to the belief the market has in our capabilities. Overall 27 wins. I'll go through the wins in just a bit when we come to that section, but overall 27 new wins in the vertical were recorded between the CAMS team and the Fintuple team together during the quarter. If I move forward on CAMS Pay, which is our payments business, we saw a 25% year-on-year revenue growth. So 2 of the non-MF businesses, alternatives grew 19% on the back of previous 2 years of solid growth in revenue in the business. Payments grew 25% year-on-year. And overall, from a share perspective and from an offering perspective, digital footprint as offered through APIs, e-mandates, and specifically UPI AutoPay, which we believe and the market believes will, over a period of time, become the accepted way of paying for SIPs and other various forms of recurring payments. I think there's been significant success in expanding our reach and kind of establishing the offerings among the clients from a CAMS Pay perspective. CAMS KRA, which traditionally for the last almost a decade sold to and serviced mutual funds. That was a core franchise. The last about 1 year, we've attempted hard to break into other segments. What are the other segments? These are other segments of the capital markets, fintechs, brokerages, those two essentially. And some of that break-in, I think, has been successful. 40% year-on-year revenue growth in CAMS KRA. Emerging, of course, the solid underpinning of the mutual fund growth anyways is there, but I think the large part of the growth comes from the fintechs and brokerages. You may have also seen some focused PR and releases from our side on this 10-minute KYC, which is essentially an industry first, an AI embedded solution which helps us onboard a new consumer within 10 minutes. They become investment ready and takes away one of the control space that the industry has had for a long time, and obviously allows selling entity, either a mutual fund or a brokerage, to turn around an account very quickly and get the investor to start participating. The rep on insurance, while you know that any final decision on dematerialization of insurance policies is still not firmly out, so we don't know the dates. There is no firm announcement yet. We continue to wait. I think overall we saw almost doubling of both EIA accounts and insurance policies, almost unilaterally done between us, the manufacturers, and individuals who are buying insurance. So this is just that momentum. It is not momentum driven by regulation. So good numbers, but of course we continue to wait for the main event. I'll slip forward on Think 360, 2 or 3 major call-outs. You know that this was an investment we had announced in March, concluded in April of this year. So essentially the first concluded quarter for Think 360 to be part of the CAMS group. We won a contract. This is our third PSU bank, and you know these are extremely competitive, hard-fought bids. The third bank between Bank of Baroda, Central Bank, and now Canara Bank has adopted Quick ID as the product for video onboarding and video KYC. Video KYC, as you know, is fast replacing traditional modes of KYC in banks, and of course the volumes there are very, very different to what we see in capital markets. So the third PSU banks have adopted this. And additionally, for our alternative credit scoring product, which is Algo 360, we won a mandate from SBI Cards. You know, it's one of the top 2 issuers of credit cards in India. Amongst the many other wins, I'll not talk of everything. CreditB also joined, which is one of the top 5 or 6 leading lending fintechs, chose to opt for Algo 360. From an account aggregator perspective, the space continues to buzz. I will talk a little more on the specific product and business chart, but 25 overall new sign-ups, and then you must have seen some focus PR from our side, CAMS FinServe winning the Technovity Award. This is a Banking Frontier Award for one of the use cases, which is bank validation. On NPS, we continue to retain the number 2 position in eNPS. Made some inroads into the POP and corporate segment. Almost 48 to 50% of new subscriptions into NPS are coming from the retail POP channel. Of course, in eNPS, we continue to hold the number 2 position. On digital, I think continuing good story. CAMS digital properties continue to climb. About an 8% quarter-on-quarter growth. MyCAMS now at over 6 million registrations. And MS Central APIs, you know that while you can visit MS Central, you can also use the utility in an indirect way through a lot of RIA, fintech kind of partners. Over 1.5 million hits on the API side, which is great vindication of the API architecture and that mode of usage growing and getting accepted in the marketplace. It was also a very solid, I would say, very satisfying quarter from an awards and recognition perspective. A lot of this you've seen. Ramcharan, who's here with me, was recognized as one of the best CFOs in the country in a specific segment. Business World awarded us the HR Excellence Award, especially for our work towards employee communities. This is an initiative taken internally over the last about a year and a half. We won the ET Datacon Award, and then I spoke about the Banking Frontier Technology Award for CAMS FinServ. Also, again, you may have noticed this, again, very exclusive recognition. Think 360 became the only Indian company to be recognized by Fintech Global in the list of the top 100 global fintechs. So this is a list of top 100 global fintechs. The only Indian company to get recognized is Think. And like I said, you may have noticed some of this. I'll move on to chart number 8. And while I spoke about market share expansion 68.3 to 68.7, what made this happen is a set of foundational metrics, a set of metrics which don't just influence the current quarter but are likely to influence future quarters and future years. And I'll just talk between this chart and the next about 3 or 4 of these key ones. What you see at the bottom is essentially the flow or the net sales market share. So stock is stock, flow adds on top of this. On equity, this market share, you can see in the bar chart, was 73% in the last quarter and went up to 99% in the current quarter. Now, of course, we're not expecting 99% to repeat itself, but for a quarter, a fantastic number. 73% is also not a bad number, a great number too, from which we grew to 99%. And this incremented flow obviously is a contributor to the market share going up. Similarly, in debt, the share went up significantly, as you can see again, from 37 to 78% in debt net sales. So foundational numbers, they have to hold out for a quarter or two more. But I think from a quarterly perspective, just gave significant fillip to the overall AUM market share. When you see transactions, that's a good story too. We are holding out very well from about 124 million in the last quarter to about 128. So that's almost half a crore quarter-on-quarter growth on transactions. And when you see unique investors, we added almost 9.6 lakh investors during the quarter, a much larger number than the previous quarter. But again, a large number of unique investors, greater net sales flow in equity, greater net sales flow in debt, and expanding market share in all those places, I think is just great vindication to what's happened in the market, but is also foundationally a solid thing, which should continue helping our business in the trailing quarter. I'll flip to the next, and if you have the chart, you can see this in chart number 9. Again, I'll talk about volumes and I'll talk about share. New SIP registrations, you know that this is one single metric which is really represented the middle and bottom of the pyramid participation in mutual funds in India. Growing quite well. If you see absolute SIP registrations from about 40 lakh to 47 lakh, 4Q to 1Q, but again, significant increase in share. 62 and some change growing to 65.2. So in terms of overall share change and new SIP registrations, almost 3% up. And again, a foundational metric because these people will continue contributing to our share of the industry for many quarters to come. Gross sales, similar trend. Of course, the growth isn't as big as 3%, but you see gross sales moved up from 24,600 to about 25,800. So almost 1,000 crore, over 1,000 crore, 1,200 crore up. And again, share almost 1% up from 58.8 to 59.7. So all the last 4 or 5 things that I've shown you, net sales and equity, net sales and debt, absolute count of MF investors, SIP, new SIP gross registration count, and gross sales and SIPs, which is great metrics in terms of foundational activity. Similarly, you see live SIPs growing from 3.5 crore to 3.73. New folios having grown to almost CAMS being at 65%. And like I said, these are both operating metrics and foundational metrics. I'll move to the next. quickly, I've spoken about this, so will not dwell for too long. 68.7 market share up from 68.3, largely driven by what's happened in equity, where you've seen, if you see the bottom part of the right-hand side, in equity, our year-on-year growth is significantly ahead of industry at 19.5%, CAMS at 22.9%. So that's almost 3.5% up year-on-year. Similarly, quarter-on-quarter, almost 0.6% up. So that's really the defining thing, which is kind of changed things for us in the last quarter. Move to the next, please. And then again, I will not dwell for too long on all of this. You've seen it across the board, year-on-year, high double-digit growth. But also, I think quarter-on-quarter, any growth which is upwards of 4 to 5% is significant in terms of giving a fillip to the ensuing quarters, which we will see in the current quarter. So all strong, pointing north, and all greens. Go to the next, please. I will quickly stop by maybe for a minute each in the next 6 charts and give you any commentary that I've not given you yet. We spoke about the 19% growth, revenue growth in alternatives coming on the back of 2 previous successful years. Just in terms of counts, and these counts continue to grow, over 400 unique funds are serviced by us, almost 150 fund houses. So a lot of repeat purchase happening there, almost 1.75 lakh crore of assets under service, which is a large part of the current outsourced market. Digitally, over 90 installations of CAMS WealthServ, and we are now about to announce version 2.0 of this product to hit the market soon with an expanded suite of capabilities. But in the last 2 years, almost at the rate of about 1 a week, 1 every 8 days, we've got these installations, and some of the funds, both PMS and AIF, almost 25 to 30% of the new traffic now comes digitally, which is a great vindication to the adoption that the market has done. Overall, GIFT City, the offering continues to remain bolstered. I do want to call out that we have chosen to go ahead with a very, I would say, well-accepted, solid, robust platform called Multifonds. This is a product of Temenos. And the reason we brought it here for our own use and for the use of our clients in GIFT City, but also outside of that, is that for multi-country, multi-currency kind of fund accounting, we wanted the best in breed to be offered to consumers, which is what we brought in now. Everything is done, is now on offer to our clientele. And then between CAMS and Fintuple, we continue to be the digital transformation partners for the alternatives industry. I spoke about account aggregator, 25 new wins during the quarter. We were also the first account aggregator to go live with mutual funds. Mutual fund data is now available, and you can try some of this, downloading your own portfolios yourself. The industry is growing. Very, very different use cases are emerging. So multi-FIP concerns, single journeys. You know that in the world of digital and fintech, journeys are very important. You don't want a consumer to repeat a step 2 times. You don't want him to give 2 OTPs. You don't want him to do more clicks than he needs to. So single journeys, supporting multiple flows, all of this is getting offered in the marketplace. We now boast of a best-in-class amongst CA's mid-side score, and I spoke about the Technology Award to you. So overall doing pretty well. On CAMS Pay, I flip to the next chart number 14. Over 50% market share. I think this has been built brick by brick when you see the mutual fund ecosystem for recurring payments. RP is recurring payments. I think brick by brick, we brought all this to work for us. And not just in mutual funds, we have expanding share in NBFCs and insurance too, but mutual funds is a significant milestone, so we are calling it out. You see a lot of numbers there, but what I want to call out and what I said was 25% year-on-year growth. Overall, in terms of revenue expansion. And then significant digital footprint, UPI AutoPay becoming almost a pioneer product in the market, but through APIs, e-NACH, etc., consistent broadening of the offering, which has led to the success. CAMS rep, I had said that we don't have yet a firm outlook on when the mandatory demand will happen, but over 5 million insurance policies and e-insurance accounts almost 100% up. We continue to do the deep tracing product across the industry in terms of finding the beneficiaries of unclaimed amounts and working with the industry with almost 1,000 crore book for processing this, and of course in the market or should be in the market soon for a digital loan assignment product here. On CRA, I've spoken, number 2 position in the NPS sales, about 6.5% market share, and almost 50% of our throughput now coming through the POP route. So action has begun there, and expect to report, growing numbers as we move on. On Think, there's been a very, very, I would say, creditable set of wins. So we spoke about Canara Bank for Quick ID, and we spoke about others including Credit B and SBI cards for Algo. But overall, we see that significant growth across product lines amongst clients, very well recognized overall in the marketplace. And then from an overall footprint perspective, number of practitioners, etc., things continue to go north. So we expect to continue reporting better and better numbers from Think. I will pause here. That was the commentary on overall company and group and operating performance. I'll hand over to my colleague Ram Charan to speak to you about the financials.
Thank you, Anuj. Over the next 5-10 minutes, I will just give you an overview of the revenue highlights as well as the profit highlights for the quarter. The AUM for the current quarter, average AUM, as you saw in the earlier part of the presentation, is around 30 trillion, 29.95, which represented 14.1% growth on a year-on-year basis. Tracking that, our revenue for the quarter was at 261 crores, which is up 10.4% year-on-year. The corresponding number last year was 236 crores, and the last quarter was 249 crores. So it's a 10.4% up year-on-year and a 4.8 or almost 5% up quarter-on-quarter in terms of the overall revenue. Out of this, the asset-based revenue, which was at 180 crores the last year, same quarter is around 190 crores, that's up 5.5% year-on-year. On a quarter-on-quarter basis, the revenue is up 2%, the asset-based revenue. The non-asset-based revenue, driven by transaction revenue and some application development revenue that we do, is up a smart 14.2% year-on-year, which is at 37.5 crores for the current quarter. And even on a quarter-on-quarter basis, it's up very nicely at 8.5%. So non-asset-based revenue, very good uptake at 14.2% year-on-year and 8.5% quarter-on-quarter. The number is now at 37.5 crores, driven by transaction and application development. The non-MF revenue, in the story on non-MF revenue doing better is continuing in large part of it. On a year-on-year basis, this is up 43.5%. This is 33 crores. And even on a quarter-on-quarter basis, this is up 20%. This does include the Think Analytics revenue to the extent of 4.5 crores. Keeping that aside also, there's a very smart growth in the non-MF revenue on a year-on-year basis and a quarter-on-quarter basis. The non-MF revenue now is at 33 crores, and you would have seen that the creep happening on the non-MF share of the overall business. What used to be sub 10% is now up to more than 12%. So we are on the right track from that perspective on the diversification. The non-MF revenue growth was driven on a year-on-year basis by growth in the alternatives or AIF, which is up 15%, on payments, which is up 25%, on the KRA revenue, which is up 40%, and there are some adjacencies in terms of websites and APIs that we bill for, that is up almost 50%. So overall, the non-MF revenue is continuing its trajectory that we anticipated for it in terms of increasing its pie, share of the overall pie. The asset mix, while on a quarter-on-quarter basis, it remained very static. The equity component was 46.5%, hence no big upside from a yield perspective because of the equity movement. But on a year-on-year perspective, it was marginally up from 43 to 46%. The major issue in this, which all of you will have a question on, is the yields. So you would see that there has been some drop in the yields. We have actually been guiding all of you over the last few quarters that there is a resetting of rates for a couple of large customers. We have indicated or stated in the last few quarter calls that this is kind of a glide path that we have, which is spread over a few quarters. We expect that the maximum impact of this has already come into the books with this quarter, and there could be some rub-off or some incremental impact in the next quarter, but post which we will be business as usual. So the takeaway from that is, as expected and as guided, there was a glided path of reduction and resetting of the rates for a couple of large customers, which should kind of get largely over by this quarter and some probably incremental impact in the next quarter. But post that, I think we are on the path to get to where we normally are. That's the commentary on the yields in terms of the AUM fees. In terms of the profits, again, our guidance has always been and our commitment has always been that irrespective of what happens from the yields or a cost perspective, we will hold the operating EBITDA margins at between 40 and 44%. And this quarter has been the annual increment quarter, which is that we did get a more than 5 crore cost because of the annual increment that we roll out for all the employees in April. So in spite of eating that cost, and in spite of the small yield depletion that we've happened, we are happy to say that the operating EBITDA, we have held it around 42.2%, which is well within or in the range that we had guided for in terms of the operating EBITDA. As you know, the first quarter is the cost quarter in which you will see the lump of the salary increment cost coming into the P&L. And going forward, we only expect that this margin will get better as the year progresses, given that there is not going to be any incremental cost at that level in the future quarters. But the AUM growth and other revenue growth will continue to happen. It's almost like a step growth in cost that happens in Q1. So given all that, our EBITDA percentage at 42.2% was a satisfactory performance. And we also, this is compared to 41.4% EBITDA that we had, or 92 crore EBITDA in the corresponding quarter last year, which means that we have seen a creep up year on year on the EBITDA percentage by almost a percentage. And in terms of the numbers, we ended the quarter with the EBITDA of 110.24%, which was 98 crores in the comparable quarter last year. So again, increase of 12.4% year on year on EBITDA number. And even on a quarter on quarter basis, we are up almost by 1% on the EBITDA. PBT, again, we were at a 38.4% PBT, up 17% year on year at 101.91 crores. And the PAT, we ended the quarter with a 76.34, which is up against 18% year on year, or a 29% margin of PAT. So overall, from a margins perspective, we have kept the margins in spite of cost pressures, in spite of yield pressures. And we expect that going forward, this is only going to show an increasing trend. We ended the quarter with a very comfortable cash and cash equivalent position of 509 crores. And the board of directors was pleased to confirm an interim dividend of rupees 8 per share. This is in addition to the rupees 12 per share of last quarter dividend, which is up for the shareholders' approval in the AGM later today. So that's the broad summary in terms of the financials. We do have the trends and various other numbers from P&L, which is available in the earnings presentation, which you can have a look at it and get back to us in case you have any questions. So with this, I hand it back to the moderator, Seema, for Q&A.
Thank you very much, sir. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Mr. Abhijit from Kotak. Please go ahead, sir.
Hi, good morning. First question is on the MF RTA business. Just to kind of get this right, what we are saying is that the current number on the yields effectively forms the base going forward, right? Barring the remainder impact that will flow in the second quarter.
That's correct. That's correct. Because, like Ramcharan said, while our prices have been very competitive in the marketplace, we've pointed out to you in the past that there were one or two contracts where we needed to do a reset. This reset went on for a period of time, and now we've kind of culminated that reset. 1Q will be the last quarter for that. So what you should see is yields holding fairly steady after this.
Okay. Second is just on the RTA side, there's good pickup on the non-asset-based revenues. And Ram mentioned something along the lines of, application development and transaction. But just wanted to check if this is really the base going forward, or there's been some bunching up that has happened this quarter.
So Arjit, that's right. When we speak about application development, it's things like, the functionalities that we do value add in terms of, for example, the MF decks or the suspicious transaction portal or the EIC, the front office portal, or some things like that, which is a part of MF, but adjacent to the MF. There is no one-off in this. This has seen a sustained interest in terms of the value addition that we do to our customers, and hence there is a revenue coming in. So this should be the base going forward. We are sure of that.
Okay, that's good to see. One question on the non-MF business. So good to see the pickup in revenues here as well. But just from a clarification point of view, this FA tie-up with Temenos, how is it different from what Quintuple was doing for you? And a related question is that when we kind of back out the yields, it comes to about closer to 2 basis points. So just wanted to check if that is really the ongoing rate for this sort of service in the AIF market.
No, sure. So on part one, Quintuple's core business has been creating a digital onboarding platform, which is what they started with. And now a very bespoke development of these onboarding platforms. So CAMS is the more industrialized product. You either buy the product or you don't. Quintuple is a bespoke product. We work with banks, especially their custody functions, to build the entire set of onboarding functions and digitization functions. That's what Quintuple does. Multifonds is a fund accounting software, and it's a fund accounting platform which is used globally. We were wanting to do something in this area for a long time, especially with GIFT City becoming what it is and non-GIFT City requirements also emerging, to be able to do fund accounting in multi-currency for people who are either raising or deploying monies in multiple countries in multiple currencies. So that is a fund accounting product which will now become available to us. It's very, very different to what Quintuple does.
And the question on yields?
Yeah, so the way we charge, if your question is yields on AIF, if that is the question, then the way we charge AIF is not entirely based on AUM, right? So almost 60-70% of the billing happens on the number of investors who are onboarded to a scheme. But for your calculation perspective, I think the yields that you are showing is consistent. It's been always between 1.75 and 2 effectively. Although, let me just clarify, the way we charge most of the AIF is not based on the AUM. It's more based on the number of investors in a particular scheme and a slab-based rate depending on the number of investors and a per month charge that we do.
Got it. I have a question on OPEX. I can come back in the queue. Thank you.
Thank you, sir. A reminder to all the participants, if you wish to ask a question, you may press star and 1 on your touchtone telephone. We take the next question from the line of Mr. Devesh Agarwal from IIFL Securities. Please go ahead, sir.
Good morning, sir. Thank you for the opportunity. First question again on the mutual fund yields. So we see on a sequential basis, we see a 5.5% decline. The yields are more like 2.57 basis point versus a growth on 7% on the overall AUM. Now my question is, you said that this moderation can continue even in 2Q. So are we kind of expecting a similar kind of moderation even in 2Q?
No, not really, Devesh. So what we had said was, think of a longer period. Think of maybe the last 5 to 6 quarters. Whatever moderation you have seen was largely emanating from, like we said, 1 or 2 contracts. That process is concluding has almost concluded, will conclude in 1Q. So whatever impact you've seen in the past is in the books. You will see a small impact in 1Q, but after that, the yields should hold very steady, which means we are at the tail end of that adjustment process. The last step is getting executed in this quarter, in 1Q.
Just to add, the most of the impact has already been seen, Devesh. So to see that there will be zero impact is not true. At the same time, it will be nowhere near what you're seeing for the current quarter.
Understood. And sir, any sense in terms of adjusting for this 1-2 account, what would be the moderation that we would have seen in the quarter on a sequential basis?
So in fact, given that most of the other customers are in line with what we expect, which is that in fact the AUM to AUMP growth, which is generally we expect around 70%, in most of these customers are upwards of 80%. So the moderation has been less on the other customers that we have seen. Almost 70 to 80% of the moderation has been because of the resetting of the yields that's happened in these two. Or we would have seen a much larger EBITDA number that you're seeing now. Understood.
Secondly, on your non-mutual fund business, this quarter we saw an inch up to 12.5%. So one, your target of reaching 20% over what duration? And secondly, if you can help us understand what is the margin profile that we have currently in the non-MF business, and what can this be, say, over the next 2 years?
So, Devesh, we had said that, and this we had said about a year, take it as 6 quarters back, that we want to get to 20% non-MF contribution over 4 to 5 years. We think we are tracking well. We are tracking well to get to 20% in, let's say, the coming maybe 2.5, 3 years. We will get there. Some of the increase that you found this quarter is obviously going to think, because that revenue has come in for the first time. The rest you have seen because you've seen revenue growth, and I showed you the numbers. You've seen alternatives grow ahead, you've seen payments grow ahead, and you've seen KRA grow ahead. And over a period of time, there could be others which will grow ahead of company growth rate, which is where the contribution is coming from. From a profitability perspective, some of those businesses are at company profitability levels. So, for example, AIF is certainly over 40% EBITDA. But at an aggregate, I would still put this non-MF business in the mid to high 20s, which means that there are small subscale businesses like account aggregator, etc., where obviously we may not have large margins. Over a period of time, as we stabilize and grow this, and let's say the current non-MF revenue, which is in the early to mid-30s, will grow up to, let's say, 50 crore a quarter. We are expecting all of this to converge to about a 35 to 40% EBITDA. So it will not be very different to company EBITDA levels. Some of the subscale businesses obviously do not yield a lot of margin today, which is the reason why we are in the 20s.
Just one more point to that. We have constantly been saying that we will continue to invest in the new businesses. And we specifically mentioned that last quarter was, when I say last quarter, I mean the 4Q of last year, was the quarter in which the gap between the income and the expense for the new businesses will be the largest. And I'm happy to say that's been the case, because in this quarter, we will continue to spend the 6 crores per quarter on these new initiatives. But the revenue has started flowing in, although it is not at a scale that you will probably get a higher margins. So we are on the right track on that, Devesh. So we will get to a place where these also mimic the other platform-based business margins.
Understood. And the final one, sir, this Think Analytics, we acquired 55%. So are there plans to acquire the balance 45%, or this is how it will continue?
No, so the plan is, and we've had the same playbook in both Fintuple and this acquisition, that we buy a little of a majority, and then we have the call option over years 3, 4, and 5. We want the founders to stay and continue growing the business. So a larger part of the pie for them will come in years 3, 4, and 5. That makes sure that the founders stay and scale the business. And it gives us time so that we are able to create a management team which will be able to learn and operate the business once the founders choose to exit. So it's a long exit period plan. Unlike buying 100% upfront, in most of those cases, as you're aware and you've seen many other companies, that the founders tend to exit after the second year. We don't want that. So we have a call option, and obviously we are expecting to own 100% in both these companies.
Understood, sir. Thank you so much.
Thank you. We take the next question from the line of Prayesh Jain from Motilal Oswal. Please go ahead, sir.
Yeah, hi. So just, sorry to harp on this yield question again. So in your negotiations, are we seeing any change in the kind of telescopic structure that we have discussed in the past? So now that the rates are being set on the lower side, is the band being expanded with regards to the telescopic structure, or it's still the same? So the main thing is trying to understand as to whether we see if the AUM continues to grow, how much more fall can we see from the telescopic structure standpoint?
Sure. So before we get to the telescopic structure, Prayesh, I just want you to be sure about one thing, which is that what is given in all this? What is given is that there is a telescopic structure. We want the mutual funds to buy slightly cheaper as they grow, and we will sell slightly cheaper. And that depletion is part of the overall plan. So there's no change to that. However, the slightly steeper depletion that you saw in the last 5 to 6 quarters was owing to a reason that we've given you. So the answer to your question is that there is no change in these telescopic structures. They are more or less what they used to be. And you have seen that we've had a very healthy CAGR in incomes. Almost you've seen that 70 to 80% of the AUM growth turns into revenue growth for us, and that formula will broadly hold. So don't expect that yields are under any pressure. In fact, I would say that outside of the couple of contracts that we referenced, yields have been holding very well across the portfolio for the last almost 1.5 to 2 years. Outside of the telescopic structure, we see no other stress. For the 2 contracts or 1 contract that we are talking about, it was premeditated and agreed. And like we said, most of this impact has now been taken. What you will see is a small adjustment in 1Q, which is the current quarter, in 2Q, and after that you will not see much. So that's really the message overall on the yields profile.
Got that. That's helpful. Secondly, if I look at your expenses, both operating expenses and the other expenses have seen a very sharp jump on a YOY basis, and even on a sequential basis, while operating expenses have increased, the other expenses have been flattish. But the operating expenses have been surging. So what's the reason for that, and what kind of run rate we should look at it?
So, Prayesh, the operating expenses, operating expenses for us, there is some variable component to it. So, 2 things. For example, operating expenses, the major contribution for the increase has been out-of-pocket expenses, which is reflected in a similar number in the top line. There is the sponsored bank charge expenses. If you see the smart uptick that's happened in the payment businesses, there is a corresponding variable cost that we incur by paying the banks. That's also been a part of this. And the entire software cloud charges that we are investing in, right? The new businesses that are there are basic CRA or account aggregator or all those things are on cloud. And the tools that we buy are in operating expenses. So these are expenses which are either variable or done from an overall business long-term perspective. And hence, you will see a small uptick that keeps happening on the operating expenses, even on a quarter-on-quarter basis. But if you remove the OP part of it, and if you see the percentage of operating expenses, they generally the operating expenses would be around 11% of my sales. But if you remove the OP part of it, because the same number is there in the numerator and denominator, and we are required to account it as an income and expense, the operating expenses always are around 7.5 to 7.8%, and that's the trend that's been holding throughout, right? Even if you see the last year or this year, it's been within this range of 0.5%, 7.5 to 8 kind of a percentage. If you remove the OP part of it, OP is more kind of a compensating entry. From other expenses, these are the real fixed expenses. These are the expenses on power and fuel, the legal, consultancy, etc. Largely, as you said, we have held this number. Last time in the earnings call, we again said that you will see only a small inflation-driven increase. But overall, you won't see a large increase. We stick to the same commentary. The only point that you note there is, there is a lot of requirement now for an audit, right? For example, PFRD will require a CMMI audit. There will be a VAPT audit that's required. All these are very expensive. And there are 3 other things that we done from an information security perspective. These expenses are in the base now. So these were some things which are not there probably a year and a half or a year earlier, which are in the base now. And then there is all these things also. Just recollect one thing, that they include the Think Analytics numbers. For example, the other expenses, includes around 63 lakhs of Think Analytics numbers. So but for that, they would have been very flat or lesser. The operating expenses also includes around 65 lakhs of Think expenses. So if you take that away, the increase is a little more moderate. So 2 reasons. One is from operating, it's a variable plus Think Analytics expenses coming in. Other expenses is broadly the fixed expenses that you will see a small inflation-driven increase going forward. But in the base, we have various other audits and information security-related audits, power and fuel. There is a big tariff increase that's happened in the state, which is causing a lot of increase from our power bills too. These are that the base now. So going forward, I don't think you will see such a big increase.
Okay. On the non-MF side, on the e-insurance thing, you've mentioned that the digital loan assignment is a new service that you've started. What I'm trying to understand here, does this kind of give you additional revenue, or it's part of the existing charges that you would get? So trying to understand whether from a longer term perspective, this could be an opportunity which will be, say, larger than the account opening for EIA charges. So that is the question.
Right now, so just like there is loan against securities and loan against mutual funds, loan against insurance is today an experimental product, which means that as of now, it does not have IRDAI permission for people to go ahead with in this format, in the digital format. What we had done was, along with the regulator and a few key clients, we set up a sandbox, and this is demonstrating the success of the sandbox. We have now applied to the regulator to allow us to convert this into a commercial product, which is where we are. When it gets converted to a commercial product, that will perhaps mirror the success of, let's say, loan against mutual funds. Of course, the scale could be bigger, but it will mirror the success of that. We are expecting to hear from them, let's say, in the next quarter or 2, and then there will be enough commercial viability of this. But today, this is not a revenue source, so to say.
Okay. Got that. Thank you so much.
Thank you, sir. The next question is from the line of Dipanjan Ghosh from Citigroup. Please go ahead.
Hi, sir. Good morning. 2 questions from my side. First, on the new deal wins, just wanted to get some sense when you onboard these new customers, is there any front loading of cost that is associated with it? While obviously, I understand that this will be yield accretive from a medium term perspective, but wanted to get some sense of the upfront cost from an setting up the business and all. Second, if I can get some sense of you mentioned that in the near term your margins on the non-MF businesses are around mid-20s and gradually maybe scaling up to 35 to 40%. So in the period when you kind of scale up these businesses and take their share up from 13% to 20% of revenues, should one see the overall margins maybe compressing a bit, or do you kind of expect some leverage benefits to play out in the domestic mutual fund business?
Okay. So let me answer the second one first. If you take the last 2 years, and I'll give you order of magnitude, we've perhaps been investing annually in the range of 18 to 20 crore rupees in the new businesses. This is essentially account aggregator and TSP as one, NPS as a second, MF Central as a third, and some amount in insurance. What started happening now is that we are seeing the color of revenue, which means some color of revenue. So let's say a business which had 20 crore cost and maybe a crore of revenue will grow from 20 crore cost and 1 crore to 20 crore cost and let's say 4 crore revenue this year, and probably will grow to 7 or 8 next year. So the gap between what we are spending and what we are earning will become narrower, and that should contribute to the overall profit pie of the non-MF businesses. At the peak, like we said, we have a steady state ship in alternatives, which is making upwards of 40% EBITDA. We have payments, which is making upwards of 30%, and then we have others. KRA would also be making close to 40% and above. So when they become steady state and get to a certain mass, the expectation is, because the labor component will always be small, they will be platform-based businesses and they have a steady kind of cost and revenue profile, they will get to 40%. So you have two examples there. You have KRA and AIF, which are both in that range. You have payments, which is a lot more competitive, is somewhere in the 30s, and then you have others, which may not be making margins today. And what I had given you was an overall basket level margin yield. As we continue the journey, obviously there will be some profile improvement in the scaled businesses, and the smaller ones, which are subscale, where we're actually investing money today, will start returning some additional revenue. So we're expecting that overall margin profile, if I have to give you a single line answer, that the margin profile of non-MF should improve from here, and therefore at a company level, it will be a net contributor, slightly net accretive than net depletive.
Akshan, on the first part, regarding new deal wins and if there is a front-loaded cost attached to it on the MF side?
Right. So on the new deal wins, what happens is that typically when an AMC sets up business, of course, there is a lot of pre-set of work to be done. But they get set up and then they launch what is called a new fund offering. Typically people come out with a single new fund offering, most of the times in equity. Most of the times, don't take it as a rule, people will target, let's say, a 400, 500 crore accumulation from that. A very successful first NFO could be 1,000 crore, but they're not very, very common. So you have a new AMC which comes in, we do the prep work, and then obviously we deploy all the technology capability, which is getting them to plug into our platform, but doesn't really create a lot of cost. Of course, we have to employ that unit, and we have to employ a set of people. Let's say starting maybe 12 to 15, 20 people will get into a unit. We'll wait for that 500 to 1,000 crore of AUM to happen, let's say in year one. So there will be a bit of a mismatch in terms of when that AMC becomes revenue accretive and when we put in cost, but those are not earth-shattering numbers. Those are numbers that we can manage in the overall book quite comfortably.
Sure. Thank you and all the best.
Thanks.
Thank you. Before we move on to the next question, a reminder to all the participants, if you wish to ask a question, you may press star and 1 on your touchtone telephone. Ladies and gentlemen, if you wish to ask a question, you may press star and 1 on your touchtone telephone. We take the next question from the line of Lalit Dev from Equirius Securities. Please go ahead, sir.
Yeah, good morning, sir. Thank you for the opportunity. So just one question. So on this Think Analytics business, so could you give us more color, how do we earn our revenue, and in terms of the new contract, and what kind of margins do we make in those businesses?
So when you think of Think, they come from a very different segment, although they are within financial services, largely cater to fintechs, banks, NBFCs on the lending side. Not so much in the capital market. So it's a very complementary operation. 4 core products. Algo 360, you saw that mentioned, is a core platform. We are perhaps one of the 2 in the country who offer a commercial service where, based on Android SMS inboxes, etc., information contained there, we give analytics based on what is the behavior of the person from a financial metrics point of view in terms of income, spending, investments, and a lot of related things. So that's a very popular platform. That's product number 1, for which you saw we mentioned things like SBI Cards and Credit B to be the new entrants. Of course, there are many established customers. There is a second product called Quick ID, which is basically a video onboarding, video KYC product, where you saw us mention Canara Bank as the third public sector bank in the country, which has joined hands with us. Of course, there are many other private sector clients, but we chose to name just 3 or 4 big ones. And as you know, the paper-based KYC will continue to get displaced by video-based and electronic KYC. And that just creates significant scale opportunities for that product. There is a third product called Flow Expert, which basically helps companies integrate a number of external feeds coming through API in a straightforward way. It's a new product, has about 3 or 4 installations. And then there is analytics, where we sell business intelligence kind of products and platforms to both the financial services industries in India and in the US, and then we have a few pharma and healthcare clients too. So those are the 4 product lines. The first 3 are, you can think of them as pure product. Analytics, you can think of it as a service, more a consulting and doing service. So it has attributes of service, which means it needs headcount. The others are typically product-based, the first 3. From an acceptance perspective, you've seen some of the clients, and of course, if you go to the website, you'll be able to get a lot more view in terms of what they sell. But a very, very promising young company, no debt, completely bootstrapped, and then from a public profile, award, recognition perspective, fairly prominent.
Sure. So like currently, what is the kind of revenue potential do we expect in this business, like going ahead over the next 3 to 4 years?
So broadly, think of them as a company at a current year run rate of maybe 28 to 30 crore of revenue. Over a period of time, of course, we would expect it to grow in high double digits, so upwards of 20% on that base of 30 odd crore. So in 3 to 4 years, you can expect that in a reasonable way, it should be at least a 50 crore operation, if not more.
Sure. Thank you.
Thank you, sir. The next question is from the line of Mr. Chandragupta, an individual investor. Please go ahead.
Hello. Am I audible?
Yes, please go ahead.
Yeah, thank you. Thanks for this opportunity. So I just want to ask one question. It's about this slide number 36 that you have, the proprietary technology platforms for and mobile applications that you have mentioned. So have we explored the option of monetizing these platforms at any point of time? Like, outside India, of course, like a software product company, that could there be another revenue vertical for us? Is there such a potential?
We have made a small attempt in the past to open up a European office and one in the Middle East too, and we had some success. But then we've been completely focused on India domestic right now. As you would see, we have one core business and about 7 adjunct businesses, a couple coming from acquisitions, the rest are our own core business. So we've chosen to focus on India domestic. Right now, we are not selling overseas, so there is no go-to-market attempt to sell these platforms overseas.
Okay, but it can become in future, if we choose to. I mean, if we decide to, then that's also possible in theory. Yeah.
Yeah, will certainly be possible. Think Analytics, by the way, has a small American subsidiary where we do consulting contracts with the financial services and healthcare people. That's a very new and a small part of the overall mix, so I didn't call it, and it has nothing to do with this chart. But just so that you know, there is a small amount of U.S. revenue. But as far as this platform is concerned, right now we are not selling it overseas.
Okay. Thanks a lot. Yeah, that's all from my side.
Thank you, sir. Ladies and gentlemen, that was the last question for the day. I would now like to hand the conference over to Mr. Ramcharan, CFO of CAMS. Over to you, sir.
Thank you, Seema. And thanks a lot to all the participants for your participation involvement in this earnings call and your continued interest in CAMS. In case of any questions, please feel free to reach out to Anish Sablani or to Orient Capital, who are our IR. Thanks once again for the time you spent.
All right. Thanks, everyone.
Thank you, sir. On behalf of CAMS, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.